Hello and welcome to another episode of Moneyfy Mantra, where we speak with industry experts on various personal finance topics, which can help our investors take informed decisions. So today we have Ms. Shaily from Tata Mutual Fund. Shaily, welcome back to Moneyfy Mantra.
Thank you. Our pleasure to be back. My pleasure to be here again.
Yeah. So Shaily heads the products for Tata AMC. We'll quickly start with our questions today. So our topic for today is simplifying your investment with index funds. So the first question, Shaily, today we have when it comes about index, what are these index? A lot of people find it very difficult to grasp this concept of index in investing.
So index is nothing but a aggregation of various securities. It is it's like a portfolio. The only difference is that when you construct an active portfolio, there is a judgment which goes behind picking each stock and creating a portfolio of 50, 60 securities. An index is again a set of securities, but the way it has been constructed is a little different. It is rule based investment. So you have 2 to 3 rules which are applied to a predefined universe of stocks, which goes into then constructing the index. And of course it is reviewed every 6 months, or in some of the cases every 3 months. So that's the primary difference between an active fund portfolio and an index. And index funds finally replicate these various indices.
So, replicating how does this replication actually work? So, how are these index funds created?
So as I said, there are 2 to 3 rules which are applied, initially. So what happens is there are broad market indices, for example, which cover the entire market, through 2 to 3 rules applied to construct. And then, you can zoom in on one part of the market, let's say a mid cap or a small cap segment, and then say that there is a index which will be constructed on this part of the market. So if and then by let's say the rule could be that the stocks would be laid down by in the descending order of free float market cap. For example, the last 6 months average of the last 6 months free float market cap is what is the primary rule there, and you will then pick up. So then the index could be constructed of, let's say, a mid cap 150. That's the way. So you've zoomed in into one part of the market, which is a market cap segment. You've chosen mid cap as your segment, and on that you applied rules, and you have constructed a mid cap index. Similarly, you can zoom in on a sector fund. You can say that reality, for example, real estate. So the sector zoomed in on is real estate developers. So again, the free float market cap and few other other rules would be applied, and then that sector is the a part of the market which will be replicated. Or you could say a theme which could cover 3, 4 sectors. Let's say a manufacturing theme. Now, manufacturing theme could have 4, 5, 7, 8 sectors which are into manufacturing, auto or capital goods or pharma manufacturing, or auto components manufacturing, and like that. So that is a theme which is, you've zoomed in again a part of the market, but this is a little broader part of the market because you have taken 3 to 4 sectors here. But finally, it's a theme. So it's part of the overall market. It's a pie. You've zoomed in there and said that again, I will apply rules and I will, create an index. Just to give an analogy so that people can understand a little better, is that I can create a music playlist, for example, and every time I do not have to, once the song ends, I do not have to think that, okay, now next which one. In the moment decision, I do not have to make those decisions every 5 minutes. There is a playlist created and it's uninterrupted, and I've picked up the entire playlist for a particular genre, like music with in the moving car or a drive. So that's the overall theme, and you have 50, 100 songs into that, and it's playing on uninterrupted. Likewise, it's this. I have defined an area of the market which needs to be picked up, and we've applied rules, and it's going on and on. But it is reviewed every 6 months. It is reconstituted every 6 months.
Correct. So, Shaily, so what are the pros, of investing into an index funds, and what are the cons? So, is it always beneficial to invest in an index fund?
See, index funds, passive investing through index funds should be looked at as one diversification. It is not active funds or passive funds. It is a diversification. For example, when I go as an investor and I like the banking sector, for example, the financial services sector or the banking sector within that. And then I say, okay, even if I'm picking up an active fund, I would want to diversify into two fund managers, let's say, so that I can go by the judgment of two. There it is a judgment. He's deciding amongst the banks which bank to pick, amongst the HF housing finance companies which one to go for, amongst the AMCs which one to invest into, whatever. So I would like to diversify across two judgments, which is two fund managers. Now here, this is another way of diversification, which is here also a portfolio is constructed through a rule-based approach. So here also I'm taking a financial services sector or a banking sector or financial services sector, for example, and that's so I could have three funds if I like the sector. I could have two active funds and one passive fund, or I could have two active and two passive. So I can diversify like that. To answer pros and cons, one is it is a diversification and it can be looked at together. And when you have larger sectors which have fewer stocks, and 10, 12 stocks, 15 stocks take 80 to 85% of the market cap take away, because those sectors are like that, like auto and reality. In 10 to 15 stocks, they would take almost consumes 85% of the market cap of the sector, which is more than 100 stocks. In those cases, it's better to go with the passive, because those sectors, those stocks, you won't be able to do too much tweaking to that. The other way to look at it is their index funds work beautifully. The other way is, if the sectors or themes are too large, for example, if it's very, very large, then it's better that, you need too much of, research, capability to go and pick stocks for the individual investor. So it's better that you take exposure to that part of the market in entirety. If it's an infrastructure theme or a manufacturing theme, do diversify, because what the fund manager would do is, even if the universe is large of 200, 300 stocks, but the fund manager would go and construct a active fund manager would go and construct a portfolio with 60, 70 stocks. So he will have to actually go overweight on some stocks. So that is his judgment that he's doing. Whereas in case of a index fund, you would just take the entire, you will take an even exposure to all the sectors, and as thrown by the rule, and an overall exposure to the sector in entirety is taken. The fund manager may zoom in on a particular segment of that sector, and it might want to skip some segments of the sector. But when you go through an index, you would take it in entirety. So the investor can diversify between an active fund and a passive fund to capture that part of the market. Likewise, in a market cap indices, for example, you have small cap funds and mid cap funds. Those funds would have 60, 70 stocks in their portfolio. But the indices have small cap 250 and a mid cap 150. So they have 250 stocks and 150 stocks in their indices. So again, the investor can diversify, because when the active fund manager is constructing a small cap portfolio, he's zooming in on few stocks, taking a call, taking his judgment and doing that. But when I'm buying a small cap index, I'm taking full exposure to full 250 stocks. So that's how the difference
Correct.
is.
So, Shaily, so, there are different types of, indexes, available in the market, and, there are various funds, which are replicating some of these index. So could you, and you briefly mentioned that, there are some broad market index, and then, there are market cap based index. So there, there are some other categories of index which have, which are emerging right now and, are becoming, institutional favorites for now. So if you could give some detail about some of the other indices which are available in the market.
So, of course, we have brought, so it's very important to know that what is being replicated. Indexes, yes, index funds replicate indices, but it's very important to know what is being replicated. So, if it is a broad market index which is being replicated, it will be average returns or market returns, not average returns, market returns that will come to the investor. Let's say within the market, one portion has been, identified to be covered through an index, then it could, both are passives. Even this, thematic passive index is also, index fund is also a passive, and the broad market index is also a passive. Both are passives. But a broad market index would give market returns. And if I have identified a particular segment from that market, then that passive index fund, or that sector index fund or thematic index fund could give higher return than the broad market. So it's very important to know. You are talking again about two index funds itself, but one is a broad market and one is a sector or thematic. So coming back to the question, and what type, how many types, or what are the types of indices which are available. So you have broad market indices like your Nifty 50, Nifty 100, Nifty 500. Then you go to market cap indices like mid cap 150, mid cap 100. Then small cap, you have small cap 250. You also have micro cap index right now. So these are the market cap indices. Then you have factor indices or strategy indices, which is like your momentum, low volatility, quality, and alpha, value. These are the strategy or the factor indices. And then you have sector and thematic. Sector is particular sector as defined by AMFI. So you have an auto, reality, financial services. These are sectors which are defined very, very clearly. And then you have thematic like a manufacturing or even an infrastructure theme, an MNC theme, an ESG theme, which will have multiple sectors being, encompassed under that one theme, 4 or 5 sectors, or maybe a little more. If the theme is too large, too broad, then more sectors would encompass. So these are the broad market strategy indices, thematic and sector indices. These are the very, and there are these equal weight indices also under market cap, which is each stock is given an equal weight, and every 6 months, they are rebalanced to bring them to equal weight. So that's the way.
Interesting. So, Shaily, so there has been always been a debate on whether I should directly invest into stock market, or should I go through a mutual fund route or an index fund route. So what really what should be the criteria that an investor should look forward for before making such decisions?
See, if somebody is glued on 24/7 into research of these stocks and companies, then maybe the person can go for individual stocks. However, when these indices are created, a lot of things are taken into consideration. One is the free float market cap, as I mentioned. Then what is the impact cost? And there are rules for impact cost for the stock to be included. Trading frequency is another rule which is there. Whether the stock is there, should, if it's an FNO stock, it's a compulsory inclusion. Then the smallest stock should not be more than, the smallest stock should be at least 1.5 times, or not less than 1.5 times. Or the biggest stock should not be less than 1.5 times the smallest stock. So, there are various rules which are there, and after which a lot of things being taken care of, and then this index is constructed and the indices are constructed. So to my mind, once you have defined and identified an area of the market, you have identified and firmed up on the basic industries or the segments which will be covered under that. You have taken care of some of the very important or the hygiene important items like your liquidity and trading frequency and all that stuff. It's a very robust vehicle and a portfolio that you have created through an index. And then in that case, it's better to diversify your portfolio between an active fund manager going by his judgment on where to go overweight on, and where to totally skip it and go underweight on, or you go within robust vehicle like an index which is created and go and replicate that. I think it's a great way to look at it and diversify into these both. Coming in as through the third route, which is individual, individuals going in buying stocks alone. I don't know whether the weights, because you could buy a real good winner, but are you allocating the right weights to that winner for your portfolio to show that CAGR return, which can come in. So I think weight allocation is a very, very important factor, which the individuals might not be able to do it on their own. So it's best to diversify between active funds and passive investing, I would say.
Correct. So, there are now, I think, more than 100 or 150 index funds available across, multiple AMCs.
Yes.
So, most of these index funds have more or less a similar performance. So, are there any criterias which an investor should look forward to compare to some of these index funds, or, I think it is just, any AMC specific thing that the customer can go for?
I think there are criterias, of course. The investors should look at the tracking error and the tracking difference. Tracking difference is what is the difference in performance of this index vis-a-vis the index fund, let's say, and the index that it is replicating. So the fund portfolio, the index fund portfolio, performance of the index fund portfolio compared with the performance of this index or the benchmark which is being replicated, there could be some performance difference because of the expense ratio and the cash. So that should be seen. That's the tracking difference. And the tracking error is actually a standard deviation or the volatility of how much difference on a daily basis does this portfolio have away from the benchmark. So how is it too volatile that some days it is too away, some days it is really tracking very closely? If the tracking error is high, which means the volatility is high, then so the investors should look for funds which with a lower tracking error and a lower tracking difference. Largely, if you have a lower tracking difference consistently, the fund would have a lower tracking error also. But it's important to look at both, because it can so happen that if the tracking difference is large and it is consistently very large, the difference, then your tracking error, which is the deviation, because it's consistently large, which should not be the case, but tracking error number would come low because it's consistently not being in line. So it is not deviating, it is consistently not deviating, and it is consistently not tracking it closely. So in that manner, that is why I say it is important to look at tracking error and tracking difference both together. And one more thing which can be looked at is the TER, which is the expense ratio of index funds. So that's another important metric which the investors can look at.
Correct. So, Tata AMC is launching, I think they've launched 6 different index funds. Would you like to give us some brief about these funds?
Sure. Yes, I will be glad to do that. We have launched 6 index funds, and all of these. I would just give a very brief, line of thought related to the GDP growth of India and relate these 6 indices. So the way we are thinking is that India, any which ways, has an ambitious goal of achieving a higher GDP, and let's say India wants to be a $5 trillion economy by 2025 and a $10 trillion economy by 2030, and by a $30 trillion economy by 2047. So as India's GDP rises, we would be replicating, or we would be going on the path of developed economies. And these developed economies with higher GDP usually have they tend to have a higher share of the overall global manufacturing output, 15 to 16%. US has 15 to 16%. We just have 3.3% share of the global manufacturing output. These developed economies have a higher percentage of GDP as spent on capital investments. India has about 3.3, 3.5%. These developed economies again have close to 15 to 20%, of the GDP as a capital expenditure. And again, as the countries grow, their per capita income rises. So when the per capita income rises, let's say for India from 3,000 to 5,000, when it is now touching close to 3,000, the positive impact has come on electronics. So first the staples, then electronics and mobile, and then the next leg of benefit would is likely to happen to the auto sector and the real estate sector, because as incomes expand, you tend to go and capture more products and more zones in life. So that's what we are expecting, that as the India's per capita income approaches $5,000, it will have a positive impact on auto and reality. And if infrastructure and manufacturing is, on the rise, and their share, they are going to be following the path of developed economies, then banking as a sector cannot be behind, because finally banking, financial services sector works on, the key driver there is credit growth. So if you have manufacturing growth and infrastructure growth happening, credit growth is already healthy at 21% year on year. And if that remains healthy, that sector is tended to do better. And the last one is healthcare. Again, as the GDP rises, the economies start sparing more money for healthcare expenditure. And India there also is just a little above 3%, whereas the larger economies, US, is about 16-17%. So, with a lot of healthcare initiatives the government is taking in terms of Ayushman Bharat and E-Sanjeevani, and they're trying to vaccinate and cover a lot of remote people in the remote and rural areas, and they're getting more people in the net, and healthcare services awareness is also increasing. So the mid-small healthcare index actually covers those diagnostics and medical equipment companies also, apart from the pharma companies. And for manufacturing and infra, the key driver is the PLI, Product Linked Incentive Scheme of the government, which is launched, which has been announced across 14 sectors. And for infrastructure, it is the National Infrastructure Pipeline, scheme, which has been announced in 2020. And the overall outlay there is about 111 lakh crores, which is a huge one. The initial announced amount was about 102 lakh crores. So these are all the drivers on ground. We are not just saying that we'll keep our currency cheap and let the exports happen and the manufacturing happen, and exports will grow. There is on ground action happening in terms of government policy, coming in, GDP rising, consumer preferences changing, people reaching out for auto and real estate, healthcare spends increasing, our manufacturing output tending to increase, because a lot of government policy is there. So it's a very driven approach which is there finally to achieve the objective of India's rise in GDP, and these sectors should and would shine if that were to happen. So that's the larger idea we have.
Thanks, Shaily. I think that was a very detailed yet a brief overview of the funds. So Shaily, with this we have come to an end of our video today. Thank you for your time and answering our questions patiently. To our viewers, if you are planning to invest in these index funds, you can come and log in on the Moneyfy app, and you can start your investment journey through index funds of Tata AMC from Moneyfy. We have given the link of our app in the description below. Further, if you're already an investing customer, you have investments spread across various AMCs and distributors, you can consolidate all together in one single app through our external portfolio tracking mechanism. So thanks Shaily for your time today. Thank you everyone for watching our video today.
Thanks everyone for joining. Thanks Harsh and Moneyfy team. Thank you.